Welcome to the 9th episode of the Sydney Contrarian, titled The Home Capital Group Demise, The Northern Rock Moment. As you are aware, I have not been posting videos in the past month as I had a few personal matters that I had to attend to. Thankfully, things are better now by the grace of God the Father. It was not an easy period, so I'd appreciate that some of you put me in your prayers. So, lots of things have happened in this past month, and I would have loved to have made more videos to cover them. Given the limited time, and I am spoiled for choice, one that is quite linked to my previous videos is that of the property markets. So I'm going to cover in this video a recent event that has impacted the Canadian property market, and that being the imminent demise of Home Capital Group, the largest non-bank mortgage lender based in Toronto. Home Capital Group is not quite in the league with the major banks in Canada. However, being the largest non-bank mortgage lender, they are a significant player in the mortgage lending market, and thus its effect on the property market as well. As we are seeing in the subprime crisis that began in 2007, the crisis began with mortgage lenders, then spreading to the larger institutions such as banks in various countries and at Wall Street, and eventually fed through into the various bond markets and stock markets and caused a lot of jobs to be lost. The reason for this is because these mortgage lenders are interlinked with financial institutions through joint business and financial transactions. So this video aims to provide you a brief overview of what has happened in Home Capital Group, followed by exploring the background of the Northern Rock Building Society that was seen to be one of the subprime crisis casualties that sparked the subprime crisis. I'll also speculate how Home Capital Group may possibly relate to Northern Rock in a number of cases, and then I'm going to provide a discussion of how Home Capital Group and its demise could sit with the Canadian property market and may even feed through worldwide, and I'll talk a bit about what could happen with the Australian property market. Again, I should provide a disclaimer that this video is by no means investment advice. I also want to say that I'm not able to predict if and when the Sydney property markets may turn around. However, I want to put it out there to you all that there is now further cause for caution regarding the stability of the financial markets. Home Capital Group made the headlines on Zero Hedge for the first time on the 27th of April after the stock price crashed 61% as it became apparent that its depositors were withdrawing their savings at an alarming rate on the fear of mortgage defaults. Now this may appear sudden, but as early as July 2015, Bloomberg had already reported that Home Capital Group had been writing mortgages to people with potentially bogus income and dubious credit standing. In other words, they were writing liar's loans to earn revenue, just as mortgage lenders did in the years leading up to the subprime crisis. As a result of these defaults, Home Capital Group announced that in order to stem its savings deposits falling from $2 billion to $814 million in the space of a month, they had to secure an extra $2 billion of emergency credit in order to cover for their financial obligations. Since the 27th of April, depositors continued that mass exodus out of the mortgage lender, and as at the 11th of May, 2 weeks since the news was first announced of their financial problems, their deposits have fallen to $125 million. So, over the 6-week period, 94% of the deposits have actually gone out the door. In short, it is a bank run. It goes without saying that once a bank run has gotten under its way, the mortgage lender itself, or the financial institution, pretty much can wave bye-bye. In order to stop a bank run, what one would have to do is to close the institution to prevent cash flowing out of the institution, then either have the government or a large financial institution take over ownership of this particular entity. But that pretty much says that it's the end of the company in itself. Well, if we look at the stock price performance of Home Capital Group, it's pretty much a write-off since the announcement of them taking an emergency credit line at the end of April. Since the beginning of the year, the stock price has fallen 66%. Home Capital Group is very much in financial distress, and they may soon fail or be forced to merge with a bigger financial institution. In my view, they have reached the point of no return. Now, Northern Rock is not the first mortgage lender to face a disaster and will not be the last. Time will tell the extent of the impact on the Canadian financial services sector, the Canadian property market, and whether this is going to spread around the world and affect the global financial system. However, I'd like to provide you with a quick comparison with the UK mortgage lender Northern Rock Building Society, which made headlines back in September 2007 after it was apparent that they were facing a bank run. What caused their bank run? Yep, you've guessed it. The UK property market faced significant wave of defaults, and Northern Rock was one of the first mortgage lenders to be severely affected, and it lost confidence among its depositors. Looking at the stock price chart for Northern Rock, their stocks tumbled sharply in one day in the middle of September 2007, coinciding with the bank run that was made public. The stocks then experienced a minor bounce after its initial crash, but the decline continued until mid-February 2008, when they were nationalized. At the start of 2007, they were trading at 11.78 sterling pounds, and by the time they were nationalized, they were trading at 96 pennies to the pound, leading to a 92% drop over this period. Now, looking at the stock prices of both companies, I cannot help but see some similarities. As to whether Home Capital Group will walk the ways of Northern Rock is speculation. However, I thought it is worthwhile to simply present this for future reference. To build upon my case, let's look at the context of the Home Capital Group demise by considering the Toronto property market, in which Home Capital Group makes a substantial proportion of their revenues by lending. You can see that the Toronto property market has been invariably rising since the beginning of 2000. Compared to Canada nationwide, and also the property markets in the US also nationwide, Toronto has performed spectacularly, albeit a bit too well. The subprime crisis provided a mere speed bump for the rise of the Toronto property prices. But what is actually interesting is that leading up to the subprime crisis, the prices at Toronto actually rose in tandem with that of the country. Those who invested since 2000 would have earned a 50% return on their properties by 2009. However, afterwards, while Canadian property prices continued a slower increase, Toronto property prices surged substantially. Over this 17-year period, an average property investor in nationwide Canada will earn around 75% return, while those in Toronto will earn over 210% return. To call that a bubble is a mere understatement. Looking at the US property prices, you can see that there is actually a wave pattern, and I'm going to have a go at explaining why you see a wave pattern. Since 2009, the reason for the wave is that this is actually the prices of properties across the US, and certain cities have gone up in price, while certain other cities have declined. So that's why you have the steady rise overall, but there are declines as certain major cities watch their property prices crash once more. If you read the news articles, you will actually be aware of how certain major cities in the US are actually experiencing a property price crash. Miami is one of them. Los Angeles even recently have seen it. And of course, don't forget Detroit, which has gone bankrupt, and other major cities which are not included, which do not include New York and San Francisco, where they're doing very well. But even they are also now looking precarious. Now, going to the property price levels of Sydney, Melbourne, and Brisbane, you may want to actually take a stiff drink after looking at the performance since 2000. The chart actually suggests that the price levels of our three largest cities have delivered even higher returns than that of Toronto for the same period. I believe that there may be inconsistencies in just directly comparing the property prices of Australia as that of Toronto, because there may be a different way of measuring those prices. But I think in the case, at least for Sydney, no adjusting for the inconsistencies will change the narrative. You may want to return to episode 4 to see how affordable properties are a problem for certain major cities in Australia. With Brisbane, I would say it's not so much of a concern, even though prices have risen 250% over the 17-year period, because their median property price is 5 years of the average annual income. So it's still classified as being affordable, but maybe marginally so. But for Sydney, the median property price is almost 10 years of the average annual income, making it the top 5 least affordable property market. Furthermore, as at mid-2016, Sydney, Vancouver, and Toronto have been widely accepted as the 3 major cities whose property markets have not suffered a big fall, and pretty much all the major cities around the world have seen some substantial property market crash. Vancouver started to wobble and turn downwards by late 2016, and now we have seen Toronto beginning to face a potential wave of mortgage defaults, which will push their prices down. As to where Sydney will head, it is only a matter of time. To say that Sydney is different for whatever reason is to really have one's head in the sand, especially now that even Toronto is getting hit. Some of you may argue that Home Capital Group may prove just be a drop of water into the ocean, and the financial system will hardly register it, but I'm going to remind you the precedent of Northern Rock Building Society, in that our financial system back then was interconnected, and that's why a failure of a small component can cause a contagion that brings down the system. This is even more so since the subprime crisis. Rather than financial institutions and the economies of various nations trying to form boundaries about itself, you now have free movement of capital, you have greater international transactions. So that actually locks the system together even more. So it makes it even more vulnerable. Now, I cannot say for sure that the Home Capital Group is indeed the Northern Rock Building Society, and therefore this is going to cause a next crash. But I would say that it is not yet time to panic or head for cover as if the financial system collapses right at its doorstep. However, the objective of this video is to warn you that something may be brewing. More importantly, you should be prepared financially and to ensure that you are not deeply in debt and investing with a complacency that the financial system is either stable or robust, or that even if it gets hit, it'll be a soft landing. The cracks are appearing, and like glass, you only need a tiny crack to eventually shatter the entire sheet. Well, that's it from the Sydney Contrarian. Stay tuned for a future episode. Once again, God bless.